our group holding structure. So from a tax perspective, we have investment arm of the business, we have a trading arm of the business, we have holding companies, which is sort of limited companies that all of the sort of financial money will flow up into.
A good rule of thumb which we follow is if it's going to be worth over £1 million, it probably warrants its own limited company structure and actually will pay for those accountancy fees and all the things that you have around it. That's one thing that we always try and do with limited company structures.
Structures, SPVs and group structures. I know, Jack, you were asked the question about this. I actually, at Property Entrepreneur, had a really good conversation with somebody there that they were actually a bit disappointed in the Property Entrepreneur because they were telling you how it was so high level, saying that you should have, structures in place and for your financial fortress, how do you get money up to your holding companies? And they didn't really explain how that process works, which was a bit of a cop out. So we share a lot, we're very open and transparent in how we go about our work, and these lives are all about sharing kind of how we operate and how you can do it too and get the best out of your businesses. Obviously seek tax advice from your accountant and how you should structure it personally, but on screen is our structure, our group holding structure. So from a tax perspective, we have investment arm of the business, we have a trading arm of the business, we have holding companies, which is sort of Jack and I's limited companies that all of the sort of financial money will flow up into. And then we have other businesses obviously alongside that as well. Jack, what was the specific question?
Basically, the question was why limited company structures, groups and SPVs for specific projects. And it is a thought process that you should go through and speak to your accountant and, more importantly, your tax advisor about on how to set them up. We have our own rules within our businesses. So if we're doing a joint venture with a new project, we would try and set up an SPV with its own bank account and its own shareholders agreement, so it's completely ring fenced out of the within the group but out of the group, if that makes sense. A lot of times it's difficult to understand at what scale do you need SPVs. If you look at mine and my brother's business, Central Suites, which is obviously buying individual houses or buying HMOs, it's not worth another limited company, bank account and accountancy fees to do an individual house that's probably worth 400, 500, 600k. I would say a good rule of thumb, which we follow, but obviously run your own numbers, is if it's going to be worth over £1 million, it probably warrants its own limited company structure and actually will pay for those accountancy fees and all the things that you have around it. That's one thing that we always try and do with limited company structures. You kind of always have to be pre-planned with limited company structures, like always opening up a new one for the next deal, even though you don't know when it is, if you're going at that sort of trajectory. And every time Ben and I set up a new limited company, it's very sort of floating. It's a limited company owned by Ben and myself, one share each, bank account but no money in it, but it's ready, sat there for the next project. When we know what that next project is, we then speak to our tax advisor and accountant and say, should we move this onto the investment company or the trading company? The tax advisor then goes, well, you're doing X, Y, and Z, you're selling or keeping or holding as capital allowances, whatever it may be, and says, I would set it underneath this group. And then on completion of the purchase of that site, we've normally got an investor coming in, taking their shares in the business and us still owning our shares in the business, but structure it economically. So it's all on the sort of point of view when you know what you're buying and how, we then get that tax advice and where it sits within the group. We now have sort of group rights within our company, so we can sort of move things around if we need to, which is useful to have. We haven't actually really done too much of that yet, but you tend to be able to move things within the group regardless if the ultimate beneficiary owner is still the same structure. So for example, if Ben and I own 50% at the bottom, 50% at the top, we can kind of move that asset up and down or side to side if we need to. But yeah, group structure is really important to get it right, because you can work really hard and lose a lot of leakage on sort of tax, VAT, structure, cost of accounts and other things. So definitely make sure you're set up right and always be trying to look forwards, which is why we moved accountancy company, because we always felt like we were just looking back at things that we had lost rather than looking forward and things that we could save. And that's a really key thing to think about from an accountancy perspective.
Yeah, nice. It's probably worth sort of touching on the legal sort of side of this as well, because one of the main reasons you would set up an SPV, a special purpose vehicle, for an individual project is that legally it's then ring fenced as well. So if that project does cause issues, that legal entity is ring fenced in its own separate limited company. So it's a way of legally kind of structuring it in a way where you're protected higher up in the group. So if this SPV9, for example, folds or has loads of issues, it won't affect everything else over on this side of the business because it's ring fenced into its own SPV. I mean, there's a lot of nuances to that and caveats because a lot of the time you might have to provide cross-company guarantees with lenders and various other stipulations. But fundamentally, when it's ring fenced, it's protected far better than it is if it's just directly underneath one of these main businesses that you run. And then just quickly on why we separate up top. So XB Group Holdings is our like main holding company at the top of the tree. Jack and I have our own then limited companies that we are 100% owners of. And then that company owns the group holding company. And the reason we do that, and we didn't start this way, and when we set it up again, looking forward, we didn't have that advice early on. XP Property, for example, XP Group Holdings was owned by Jack and myself in our personal names 50-50. Well, the problems that you have with that is that if I want to, in 2 years' time, get a mortgage and I want to show more income, for example, by taking and drawing more dividends, if I say I want to take 100 grand out of our business this year, Jack, and Jack says, well, fucking hell, I'm going to pay a shitload of tax on that. Why do I want to take 100 grand when I don't need it? So if I take 100 grand out, Jack is also going to have to take 100 grand out because that's how our like shareholding and our shareholding agreement stipulates. So if we have separate companies that Jack and I own, we can take the dividends out into that holding company at the top. I can then take that £100,000 out into my personal name, and Jack doesn't have to do anything with that 100 grand. So he can keep it in his holding company and also loan it back into the businesses down below if he wants to, without having to take out more money unnecessarily into his personal name and pay 40%, 50%, whatever it is, 55% tax on that income coming out of the head business. So hopefully that makes a bit of sense. But speak to your accountant, get their advice, make sure that you're looking ahead and planning with a structure that suits your trajectory of where you want to be in the next couple of years and ring fences things from a legal perspective.